Welcome back to Opening Bell. And we're happy you're here with us. Sam Burns, Chief Strategist, Mill Street Research, is with us because we're into December. We have so much to talk about. It's been sort of a really exciting few weeks. We wrapped up November with a quick rally. You know, the NASDAQ was up 5%. Didn't squeeze out the gain, but the S&P and the Dow did that. And now, there's a lot of talk about what happens. Are we going to have a Santa Claus rally? What's your big picture feeling now for, now to the end of the year?
It's great to be back, Nicole. And I'm thinking that the market's probably going to hold up through year end. My guess is that the risk appetite for investors is still there. It's kind of rotating and shifting away from sort of the most speculative stocks to kind of the broader market now. But I think people still want to own stocks, and with the Fed likely to be cutting rates, I think that's probably going to keep kind of a floor under markets. And earnings have been pretty good, and earnings estimates still look pretty good in our work. So not a lot of real big reasons for markets to sell off, assuming no other sort of big policy shocks between now and the end of the year.
So now, as we see some dips in some stocks, I mean, how are you going to pick up stocks now in this, I guess near term, let's say short term, not necessarily just December, but short term, value over growth? What are you looking to sort of take positions in as you're seeing market rotation? Explain the sort of environment and what you're looking for.
Yeah, so I think what we had from sort of mid-April through mid-October was just a buy all risk all the time, super high risk kind of scenario where the most volatile stocks, regardless of earnings or fundamentals, including things like crypto, all went up across equities, debt, everything. Now we're shifting away from that. Some of the really high risk stuff is starting to pull back more, and people are focusing more on companies that have earnings, where earnings are improving. And I think that's kind of stage two now, where people still own stocks, but they're rotating more into either stocks that have earnings away from those that don't. And then some of the sectors that have underperformed, like healthcare and financials, are two sectors that I've been recommending clients add to. Their earnings estimates have been improving or holding up. Their valuations had gotten cheap, and some of the policy risk has been lifted from healthcare. Financials are potentially seeing, particularly the big banks, potentially deregulation along with rate cuts and strong markets and things like that. So I think some of these sectors that had not been able to keep up with tech for a long time are potentially more attractive now. I think financials and healthcare are two of those. I still like tech, though, probably less so communication services, which is kind of the cousin to technology. Some of those areas have started to see some weakness. Kind of starting to see more winners and losers kind of in the AI related space among mega caps. And I think that's going to be the theme over the next few months, is picking some of the winners and losers rather than just sort of buying everything, which is what we saw kind of between April and October.
Yeah, understood. I mean, when you look at different areas, is there anything that you want to avoid a bit?
Yeah, I'm still kind of skeptical about the commodity space, except for kind of gold stocks, which are doing well thanks to the precious metals. I think oil prices and except for maybe some refiners are still going to struggle. A lot of the consumer sector is still not particularly good in our work. There's a few pockets of strength here and there, but overall, I think some of the consumer space is still facing issues from tariffs as well as immigration, things like that. The hotels, restaurants, leisure, that kind of space has been struggling a lot lately. So those are kind of the areas I'd be a little more cautious about. I still think there's a little bit of that kind of K-shaped economy going on. The more high-income consumers as well as the larger companies tend to be doing fine, whereas the lower-income households and smaller companies are still struggling a bit. They've been impacted more by policy as well as by higher real rates for a while now. So sticking with large caps, I think some of the consumer and commodity spaces are the places to kind of watch out for.
Yeah, and at the same time, when we talk about healthcare, for example, what kind of stocks do you think would be a good value play, or at least provide a good pick?
So some of the the names that have shown up at the top of our rankings, and of course, my work is mostly quantitative stock selection tools, so I'm not doing the kind of fundamental deep dives on these companies, but looking primarily at where earnings estimates are rising and the price action and the valuation are supportive, and kind of screening kind of for what names show up well there. Cardinal, McKesson, Edwards, UHS. Some of those names are the ones that show up at the top of our rankings now within the healthcare space right now. And again, mostly because we're seeing those are the areas where analysts are raising earnings forecasts. And that's really what you want to see is where the changes, the deltas in the earnings forecasts are positive. And that's, kind of where to look for fundamental strength. Healthcare is still a very, kind of a diverse sector. There's, still a lot of areas that are weak. But there's been some improvement. I think some of the pharma space and biotech have seen a lot of the risk from kind of government interference and price controls has been kind of reduced over the last few weeks. And so I think investors are more willing to kind of go in there and look around and see what looks good and not kind of fearing kind of government overreach quite as much.
And what about tech? Do you think there is some opportunity there? I know, again, and you're looking at it in sort of the charts and quantitatively, but is there some tech that sort of stands out to you so you have some good charts there?
Yeah. So there's definitely some names that show up pretty well now. So they'd be names like Nvidia, of course, is the big one that still looks pretty good in our work. Cisco, Micron, AMD, actually Microsoft, even though it's pulled back and lagged somewhat lately, still has supportive earnings trends. Whereas names like say Meta or which even though despite its rally today has had kind of a negative inflection in its earnings estimates. Tesla, Intel, Netflix, even those are kind of the names in that kind of communications services and some parts of tech that are still struggling, still relatively weak in our work, and probably better to avoid within the tech space.
Yeah, understood. And as you like some tech names and some healthcare names, you said you're avoiding commodities. And the commodities story, we were talking about how gold and silver and copper all hit highs in the same year recently and haven't done so since 1980. At that time, there was geopolitical worries as well. But now you're just avoiding that and looking for better value. Final quick thought, Sam?
Yeah, and I think, like I say, staying with equities and staying with tech, but looking for some rotation, outside of the AI tech speculative space, and avoiding kind of the commodity and consumer areas that have been struggling the most. The economy is holding up okay. Fed rate cuts will help a little bit, but I think overall it'll be less of a straight line market next year, and really got to focus on where the earnings are going to be.
All right. Well, thank you. We have futures somewhat mixed today. We have a winning week thus far. Sam Burns, great to see you, Chief Strategist, Mill Street Research. Thank you.